The US Treasury Department recently announced that the special measures used to pay federal government bills had dwindled to $88 billion, down from $110 billion a week earlier. If the debt ceiling is not lifted or suspended, and this $88 billion is exhausted, the U.S. could default, which Treasury Secretary Janet Yellen has warned of. In an interview, Yellen said that not raising the debt ceiling would damage the U.S. credit rating and lead to defaulting on some obligations, including U.S. Treasuries and Social Security recipients, something that has not been done since 1789. Yellen also rejected the idea of prioritizing debt repayment, believing it would be a de facto default. This means that the U.S. Treasury Department must either pay all principal and interest or default on all U.S. bondholders. A scheduled negotiation between the U.S. Congress and the White House over the latest debt ceiling has been postponed, further exacerbating market fears of uncertainty and risk over U.S. Treasury bonds in the future. The yield on the one-month U.S. Treasury note has been soaring in the past 2 weeks, indicating increasing fears of default. Previously, U.S. Treasury bonds were considered relatively risk-free assets, and the U.S. Treasury Department and the White House have threatened Congress to unconditionally raise the debt ceiling based on this advantage. However, the U.S. debt ceiling deadlock has been difficult to break, and the confidence in U.S. Treasury bonds and the U.S. dollar seems to be falling short. Investors are becoming increasingly anxious about the U.S. default, with the U.S. Debt Fear Index rising to a new high, and the one-year U.S. Credit Default Swap (CDS) trading price reaching its highest level since August 2011. A report released by the White House predicts that debt default could cause serious damage. The postponement of the negotiation between Congress and the White House adds to the concerns in the market. Global buyers of U.S. Treasury bonds are growing more eager to sell these bonds before June 1st, as there is uncertainty about whether the U.S. Treasury Department will be able to make timely payments. For a long time, U.S. Treasury bonds were considered safe investments, and the U.S. government has relied on this perception to pressure Congress to raise the debt ceiling. However, over the past 4 months, breaking the deadlock on the debt ceiling has proven to be difficult, eroding the confidence of the Treasury Department and the White House in U.S. Treasury bonds and the U.S. dollar. The fear of a U.S. default has resulted in a rise in the U.S. Debt Fear Index, indicating growing anxiety among investors. The trading price of the one-year U.S. Credit Default Swap (CDS) has reached its highest level since August 2011, reflecting the increased perceived risk. The White House has warned that a debt default could have serious consequences, causing significant damage to the economy. The situation remains uncertain as negotiations continue, and the market is closely monitoring developments surrounding the U.S. debt ceiling and the potential for default. Thanks for watching. Subscribe for the more. See you tomorrow.